If we get a 10% decline in the dollar in a very short period of time, maybe the next month or two, that should really ignite a fire in the commodity markets.
In today's video, Peter Schiff, founder, CEO and global strategist of Euro-Pacific Capital, gives a warning that the 2008 crisis was just the prelude to a larger sovereign debt crisis in the United States that may lead to a collapse of the US dollar.
Silver's up 96 cents, almost $1 an ounce today, above $24. That's why some of these silver stocks that I own are up 10 or 11% just today. But the point I'm really trying to make here is that the better than expected inflation numbers are actually a catalyst for future inflation to be higher. Anyone who is looking at the recent improvements in the CPI is basically looking in the rearview mirror. They're ignoring what's happening through the windshield, which is the dollar tanking. And in fact, I think if the dollar breaks much more, I think the dollar index is going to make a sharp move from 100 to 90. There's some support down at 90 on the dollar index. And so I would expect that if the dollar does break about 10%, it will stop falling at least for a while at 90. I mean, if it doesn't bounce off at 90, then it's in even more trouble than I suspect. I mean, it's in a lot of trouble, but it should bounce off of that level just looking at a chart. But that's a big drop. That's a 10% decline. If we get a 10% decline in the dollar in a very short period of time, maybe the next month or two, that should really ignite a fire in the commodity markets, particularly in oil. I would expect the oil price to shoot above $100 a barrel if we get a 10% drop in the dollar. I also would expect gold to make a new record high. It'll probably move above $2,100 an ounce if that in fact does happen. But the point is, if we get this big break in the dollar, that is going to filter through to the CPI. It's going to put a lot of upward pressure on the CPI because a lot of the downward pressure has come from falling commodity prices, particularly energy prices. Why did commodity prices fall? Well, because the dollar rose as a result of anticipation of a tighter Fed fighting inflation, hiking interest rates. That brought down commodities, which helped bring down the CPI. But now that investors are smelling the end of the hikes and are starting to get a whiff of the cuts, the dollar is getting clobbered. And this is very inflationary because not only is it going to push up commodity prices in general, but a weaker dollar is going to push up all of our import prices. Everything we import is going to cost more. So these record trade deficits are going to go to new highs because the weak dollar is going to make everything we import more expensive. A lot of people try to say that, well, if you have a weak currency, that will reduce your trade deficit because it'll help your exports. Well, it's not really going to help our exports because we don't export that much. I mean, we export food and things like that, but the stuff that we import, we can't produce. So it's not like we could just switch to a domestic source when the dollar goes down and imports get more expensive. We just have to pay more for those imports. So a weaker dollar is going to push up the trade deficits. Also, it's going to push up the cost of importing all that stuff, the transportation costs. So larger trade deficits, higher import prices, higher commodity prices, these are all going to put a lot of upward pressure on the CPI. So investors have it wrong. The stock market is up. It's only up about 150 points right now. It was up maybe 250, 300 earlier in the day. And by the way, it's rallied the last couple of days in anticipation of this good number. And the bond market is rising. Now we got the yields on the 10 and the 30 year back below 4%. But the yield curve is steepening because the 30 year is falling a lot less than the 10 year. But again, I think that the bond markets got it wrong. I thought on my last podcast, maybe they were starting to figure it out. Well, maybe they haven't figured it out because they should be paying attention to the forward indicators like the dollar, like gold, like oil, and not the lagging indicators like the CPI. Looking again at the metals markets, gold is up $25 an ounce. We're now back above 1950 at 1956. In this recent pullback, we never got below 1900. Remember, I talked about the fact that we were below 2000, and a lot of people thought that was significant because gold wasn't holding 2000. What seemed more significant to me was that it was holding 1900. So even though it was below 2000, it wasn't very far below. And we had a very big correction in these gold mining stocks, which really looks to be over. In fact, the GDX is up 5% today. The GDXJ up 5.5%. If you recall, on the last podcast, I was really pounding the table on these gold stocks. Hopefully some people followed my advice and put some more money to work before today's rally. Although even if you missed out on that, this rally is still nothing compared to where we're going or compared to the pullback. Like if you look at the GDXJ, the 52-week high is just under 44. So even with today's rally, we're barely above 38. So that's a long way to go. Meanwhile, if you remember where this index was back in 2011, and if you don't remember, I'll remind you, I'm going to go look at it now. But the index was well over 100 here, 122, that's 2012, 156. That looks, no, 158. Nope, 165. I keep scrolling back. Nope, 171.88. That was the high for the GDXJ. Over 10 years ago, in April of 2011, we were at just under 172. We're at 38. So that just puts in perspective how much further this index could rise. I hope you guys aren't hearing all these texts that are coming in on this computer. I don't know. They're annoying me. But so there's not many things that you can buy at a fraction of their 2011 price. I mean, think about all the inflation that has taken place. And by the way, yes, gold in April of 2011, got up to this level very briefly, but gold stocks obviously were, many, many times higher than they were. And gold at this price looks a lot more stable than when it was in 2011, where we spiked up there. We have built this enormous base. The price of gold has been high for a long time. So what I was trying to say is that we have a long way to go for the GDXJ to get back to where it was 12, 13 years ago, even though the price of gold is pretty much where it was back then. But the odds of a significant rally are much better given all of the time that we've now spent building this base. The reason that we have prices so much lower now than we had back then is mainly the sentiment. Back then, people were a lot more optimistic on the gold rally. A lot more people thought early in the days of QE that the gold rally would continue. And so they were buying gold stocks as a hedge. Now, they were right. They were just a decade too early because we were able to not only get away with QE1, but QE2, QE3, QE4. But there's so much more inflation in the pipeline now than there was back in 2011. Investors should be even more optimistic on gold stocks now than they were then, but they're not. They're extremely pessimistic. They're no longer worried that QE is going to cause inflation, even though it clearly has. They've seen this surge in the CPI, and they don't understand that that is the delayed consequence of the very inflation they were so worried about in 2011. They were right to be worried. They should be even more worried now, but they're not. They're complacent. And just like everybody was fooled into believing that there was no inflation. That's why we got the huge drop in gold prices and gold stocks in 2014, 2015, because by then investors decided that the inflation they were worried about in 2011 never manifest. That guys like me, we were wrong to warn about inflation. That's when Paul Krugman was taking his victory lap, pointing at me and other people, saying, these fools, they were thinking that QE was going to cause inflation. And look, inflation is below 2%. It was that environment that allowed gold to fall back to 1,000. And even though it's risen back up to about 2,000, the sentiment has never recovered to the level it was in 2011 because people still don't get it. And just like they thought inflation was never going to rear its head, and then when it finally did, they thought it was a good thing because it meant that we could average up the years of inflation being below 2%. And then when we got too far above 2%, everybody said, well, don't worry, it's all transitory. Now the same people are saying, okay, well, it wasn't transitory, but don't worry, the Fed has fixed it. Yes, they were late to the game. They let the genie out of the bottle, but all we had to do was move rates up to 5%, and the genie is going to go right back in the bottle. They are completely wrong on that outlook. This is just the early stages of massive inflation, right? What we saw in 2021 or 2022 rather was just the beginning. And anybody who believes that the fire is out just because we've got year over year core down to 4.9 is sadly mistaken. And this entire stock market rally is built on a false foundation. That is the belief, that is the basis for this rally, that inflation is gone. And not only that inflation is gone, but that because it's gone, the Fed is going to be able to cut rates back down to the low levels that the markets got accustomed to ever since the 2008 financial crisis. Well, those days are gone for good. They're not coming back because we finally caught up to the inflation wave and there's no getting off it.